Welcome to the daily update, where I'll go over the action in the market for Thursday, April 18th, and then we'll see how things look for Friday, April 19th. Incidentally, as I start recording this, there is news out of the Middle East that Israel is retaliating against Iran. I'm not sure at this point, at the time I record, if this is over now or if it's just getting started or if we're in the middle of it. But it's having an impact on the futures. I took a quick screenshot to show you where things are at the time I record. Now, this is going to change. This is many hours before the market opens. So that might have a real impact on things, or by the time the market actually opens, maybe things will stabilize. We never really know how these things are going to play out. In Thursday's session, we had another down day. This negative bias, this negative trend still continues in the short and intermediate term. We're becoming more oversold in the short term and even seeing our list grow in the intermediate term. So we'll have to see if the market can try to find some kind of support to bounce up off of. But for right now, things are shifting more negative, but we're still positive in the long term. Let's go back and talk about what happened. We did have a higher open, and that's been kind of the pattern lately. It seems like the futures give us a little bit of an upside right when the market opens, and then it quickly goes away and then leads to selling later in the day. So the open was higher. We climbed above the daily pivot at 5,036, but we didn't get all the way up to R1 at 5,054. Then this is when we started to fall back. This is why I say the amateurs open the market, they're getting sucked in. And then once that's all done and all the backlog of orders and things that were set during the night, once that gets dealt with, then the professionals come in and do what they want to do. And prices ended up falling back below the daily pivot at 5,036. And then we went negative. We fell below the unchanged level, but we did not get down to S1 at 49.94. So now we're dealing with this 5,000 level. Prices then chopped sideways and closed slightly negative. We were down 0.22% and we're still below average with volume. We're still more negative in the short and intermediate term. Now, depending on what your viewpoint is or who you listen to, this is more normal. We've had a really good run up. We had a great fourth quarter to 2023, a phenomenal first quarter to 2024, and it should only stand to reason that we might see some weakness as things consolidate, and we can still maintain a bigger picture positive look on things and even have a pullback nonetheless. Where on the other side, you have the perma bears. They're like, okay, this is it. We're finished. Market's going to just keep going down. We're going to have this huge correction. And who knows what will actually happen. We can't really look ahead to see. And that's one of the shortcomings that people think about technical analysis. It really doesn't let you predict. It's like predicting the weather. You might have an idea that the weather will be good in July on a specific day at a specific time, but you don't really know. Well, all we can do with technical analysis is get a really good evaluation of where we are at right now. And based on where we're at right now, this is the probability that things are going to either go up or down or sideways from here. And then the next day we fall back, regroup, reevaluate things again, and then see if we come to the same conclusion or a different conclusion. And that's more of my whole approach to things. And right now it's focusing on the geopolitical concerns as we're seeing an escalation in the Middle East. Some comments that we can make. Tesla ended up hitting a new 52-week low. The earnings that came out, some were positive, some were negative, so they were mixed. Oil did fall, so and it might be going back up. I didn't check the price of oil before I started recording, but we closed at $82.09 per barrel. Here's our short-term list, getting a little bit longer. We have the rate of change going back 5 periods now, looking extreme negative. The 20-period exponential moving average based on the S&P and the 20-period simple moving average of those stocks inside the S&P. The stochastics chart, the force index, the boom indicator based on 20 periods, the slope oscillator, and the RSI based on 9 periods. Intermediate term also getting a longer list now. The CMB composite, the standard deviations chart, we finally went down into that -3 channel. The rate of change going back 20 periods. So now we're seeing short-term rate of change based on 5 and now more intermediate term based on 20 periods. That's looking extreme negative. The S&P and NYSE McClellan oscillators, the PMO studies, the Swenlin trading oscillator based on price, and now we're getting extreme with the NASDAQ 100 bullish percent index, and the Chaikin money flow is starting to get extreme negative. And that's a smart money indicator. We're still extreme positive with our 150 simple moving average study. And we're wondering about this scenario. The idea that the market had been developing and going with is that the Fed is likely done raising rates. And the Fed has pretty much confirmed that. Now, that could change if we get a lot of stronger than expected economic reports, or if these geopolitical things really continue to escalate. That will change the whole scenario. Are they going to cut rates in 2024? It looked like at the beginning of the year, 6, maybe 7 rate cuts. Then it got whittled down to 3, and that's kind of what the Fed was coming up with. But then we've had these stronger than expected economic reports after that, which is even questioning what we're seeing there. And they're wondering, are we even going to get any rate cuts in 2024? And if they do, it might be into 2025. The market doesn't like that, and that's why we're seeing more of a negative bias behind what's happening right now. The dollar was up and interest rates were also up. This is pressuring stocks. When you take both of these together, we closed at 4.65%, which was right where we were at after Wednesday, where we had been at 4.59% for the 10-year yield. We're still inverted with the yield curves. Sentiment ticked down to 34 where it had been 35, so we're negative there. And we're establishing more of a trend now, and that trend is negative. The ADX, the average directional movement, it is going above its moving average and it's crossing back above 20. So we're seeing a confirmed trend. The red line is on top, so that trend is negative. The bias is negative with the down day. Bias is usually if we had an up day or down day. Momentum is the last number of days kind of taken together, and that is also negative. And here's a screenshot that I took just before I started recording. This red line was about where we closed in Thursday's session, and we were drifting more or less sideways. Then we have the initial overnight session, and this is when things started to escalate. Now we're up off the lows, so I'll be keeping an eye on this. We're also going to keep an eye on other markets like oil and gold and things like that. So we don't know. Have things worked themselves out now? Is it over with, and now we're bouncing back up out of that? Or is there still more to come? But we're down 0.86% from the close in Thursday's session. So we'll be just waiting to see if there ends up being some kind of a gap by the time the market opens. The economic reports that came out, this is where we had probably the longest list of the week, but they were necessary, but nothing really major as far as the reports that came out. We got the weekly initial jobless claims. They came in at 212,000. That's less than the 215,000 they thought were going to come out, and the same as what we saw last week. The continuing claims are at 1.812 million. Last time they were at 1.810 million. And I have charts to show this to give us some perspective here. The Philadelphia Fed Index came in at 15.5. They expected it to be at 0. Last time it was at 3.2. Existing home sales were at 4.19 million, about at the 4.2 million they had expected, and down from the 4.38 million that we saw last time. Leading indicators, this is something that I tend to pay attention to. The reason why a lot of people don't really pay attention to this is a lot of the things that go into this indicator are already known before this indicator comes out or this report comes out. And so it's not necessarily a surprise, but it was down 0.3%. They even more than the 0.1% they had expected. And last time it was up 0.2%. Here are some charts. Here are the weekly jobless claims. We look at the black line, which are just the raw numbers, and they were unchanged on the week. And we're flattening out a bit here with the 4-week moving average. That's what we really keep an eye on to see the general trend. Continuing claims are also going up just a little bit, and the moving average is going up just a little bit as well, but we're not seeing a really big change there. And then we take the initial jobless claims, which are in red, the continuing claims in blue, and then the latest unemployment rate that we received to get some perspective there. Because this chart can be really hard to read, I blew it up here just to give you another little perspective of where things are at with each other. Here is the Philadelphia Fed manufacturing, where it really spiked up. It showed a lot of strength. So that's looking good for the Philadelphia area. And then this is the LEI, and this is thanks to an improved 6-month growth rate. The LEI did not signal a recession in March. We are seeing some improvement. Now, when we come down and we drop below this red line, that is a recession signal. To date, we have not gone into a recession, and we're seeing the LEI show some improvement and coming back up to the red line. So even though it was down, overall, it is showing some improvement overall. Here's some blog charts that I ran across, and I showed this not too long ago. This is put out by Real Investment Advice. This is the liquidity index. As a general rule, when the black line, which is the S&P 500, and then the red line, which is liquidity, when this is going up, that means there's more money going into the market, and that money goes in to buy stocks, and that tends to be more positive. And that's what we're seeing right now. And basically the conclusion is that as they've been adding money to the market, this has really been fueling things to go higher in the stock market. And then here's a bunch of numbers. I tried to put a red box around the takeaway from this. It says positive year over year, 12 months in a row. What happens after that? Well, when you look 1 month, 3 months, 6 months, and a year out, the average is we're typically up. And the further out you go, the further we see as an advance. And then what is the median during that time? So this is more strength leading to more strength after that. So this is, we're going through a difficult time right now. If you take a little bit bigger picture look at things, it's still looking positive. And then these are buybacks. This is what gives an awful lot of support to stocks, and we're seeing those continue to go up as stocks are buying back their own shares, which makes less shares available on the market. And then it also pumps up the price when they actually go in to buy those shares. Then here's a look at the 10-year yield with some different studies on here. I don't dissect this as much as this chart does. I really just want to keep an idea in mind of, are rates going up or are they going down? I don't do an awful lot of technical analysis on the rate yield itself, and then we compare it to other markets where we're clearly seeing where the 10-year yield has been going up, and that's been pressuring stocks. And here's the probability of a recession in the next year. It's dropping down to about 15% now. So things are really starting to drop off in that. We have the Bloomberg consensus, which is the dark blue line, and then the market implied probability, that's also been declining. And then what Goldman Sachs thinks will be the likelihood of a recession. And then the what's the most crowded trade? Even though it's fallen back, the Magnificent Seven, the dark blue area, this is where we're at right now. There had been a lot more folks buying into this, but that's trailing off. But it's still what most people are doing right now. And then it lists some of the other things that seem to be popular at the present time. And then looking at the increase in commodities, we're seeing the CRB index going up. And I cover that in the intermarket analysis video update that I do once a week. And we're seeing a lot of money going into that. And so that's another place that people are finding some interest right now. And then this is the first time since December 2021 that investors expect global growth to accelerate. So folks are getting a little more optimistic about things. The dark blue line, these are folks that are expecting a stronger economy, not only in the US, but across the globe. And then this is the year over year change in the S&P 500. And these two have a tendency to go in the same general direction. Couple of charts here. This, I don't follow this guy. This is another perma bear. I think he's with Morgan Stanley. His name is Mike Wilson. Isn't he with the Beach Boys or something? But they go back. Somebody posted this. This is from Bar Chart, actually, where what he was saying at that time and then what the market did after that. And you can see this. I mean, they actually pay this guy you would be way better off doing the exact opposite of what he has said. I have my own group of perma bears that I follow that kind of give me a source of entertainment. But like right now with us going down, he's like, yeah, I told you so, but he was wrong in pretty much all these other picks. You might want to stop this and look it over just to see what he was saying at a given time. And then we're keeping an eye on the cycles. We kind of seem to be sticking to this where we topped out earlier in April and now we've been coming down, and we may see some more weakness here according to the 2006 and 2012 cycle going into about the 24th of April. Here's our intraday chart. It was a pretty quiet day overall. We did have a little bit of a higher open. The futures were slightly positive, and it looks like, okay, are we going to try some kind of a bounce here? We got above the daily pivot, and we kept going up. We stalled out, and it seems to be there had been some support at about the 50-55 to 50-50 level. I've been focusing a little more on the 50-50 level lately. Well, now that we've fallen below that, what had once been support is now becoming resistance, and we came right about up to that level, and that was when we set the high for the day, and then we trailed off, went down below the daily pivot, we went below the unchanged level, and then we chopped more or less sideways, and things became really quiet as we went into the close. And here's our intraday chart. I tried to take another screenshot of this right before I started recording to show you how the overnight session, or the initial overnight session, is really trailing off at the present time. This is the 10-minute intraday chart of the SPY. But we're still hanging in there when we compare large cap growth with large cap value. They're both going down, but the blue line is still on top. But please keep in mind they are on different scales. And here's our S&P growth to value ratio, also declining. It looked like we were seeing some improvement, but pretty much throughout this whole week to this point, through Thursday's session, we've been seeing the growth to value ratio going down, and that's been more negative. Our end of day chart show the growth was down where value was up for the large caps. It was down for the mid caps and up for value. It was down for the small caps and up for value as well. And so we're trailing off here with our growth to value ratios, with the small caps, with the mid caps, and with the S&P 500. We're also showing more weakness when we look at discretionary to staples. That is continuing to show some weakness as well. Large cap growth is also starting to come down. It's a little further below its 50-day moving average now. But the small caps they were actually up in the session, but we're seeing that the large caps are holding up better than the small caps. So that's why we're seeing this ratio going up. The Wilshire, which is a broad market measure, still continues to show more weakness. And then our trend is now negative. The ADX, which is the dark black line here, that's the main indicator. It's starting to go up. I put a moving average on here to give us some context of direction. We're above the moving average and we're above 20. So now that means that we are in a trending environment. And then which line is on top? Well, the red line is on top here. So that's negative as the green line is going down. So this suggests that we are in a negative trend. We're seeing pretty much that same thing in the short term, where the trend is getting a bit stronger. The red line is also on top. And we're still below average overall when we look at volume. You got a lot of folks that just aren't participating right now. Here is sentiment. This is a couple of days old, where we came in just under 4 with the investors' intelligence at 3.9 after coming off a very high reading. The Ulcer Index continues to go up as the market's been going down. That's showing there's an increase in fear, but we continue to trail off a bit here with the VIX, both with the line chart and the bar chart. Even though we were down, and we've been down the last couple of days, the VIX is coming off of some really high readings that it had been giving. And we're also seeing volatility of the VIX continue to decline as well after it really spiked up. And then I pointed this out in yesterday's video. This is Tom Bowley's research, just showing what tends to happen with the S&P when the VIX is at different levels. And when the VIX is really low, that's when the S&P does its best. As the VIX gets higher, we still see positive returns here until we get above 20. Now, we're not above 20 right now, but if we do get into that area, that's when we tend to see more negative annualized returns. But the momentum of the VIX continues to be up as the MACD is going higher. The equity put call ratio also picking up big time as a lot of folks are hedging. And so we're seeing our 5-period continue to go up. That's negative. And the volatility risk premium is still giving us a pretty high reading. We're above this band, showing there's an awful lot of volatility in the market right now. We're coming down just a little bit with this fear gauge, but it has been spiking up. This other fear gauge continues to go up as well. So fear is really increasing right now with the other different measures that we look at. We did get the latest reading of the American Association of Individual Investors. We were down a week ago, so they're feeling a little less optimistic. They're still above zero, but they're coming down after feeling more positive about things. Our advanced decline line continues to show weakness, both based on price and volume, even though we were pretty much flat based on volume. The indicators are kind of, as I go through them, you'll see that they're kind of strange. We're actually going up with a couple right now where you would think they'd be going down. We're decreasing with the 5-period moving average of the new highs, new lows. We're also declining with the 10-period. And this is one of those things where we're turning up just a little bit with the short-term advanced decline ratio, and we're flattening out a bit with the longer-term advanced decline ratio, but we're still decidedly negative here. Accumulation distribution is below the moving average and declining. That's more negative. Chicken money flow continues to be negative, and we're wondering, are we getting to an extreme negative reading? Chicken oscillator continues to be negative, and we're declining with the NYSE cumulative advanced decline line, and see how the actual broad market was a little bit stronger. And this turned up just a little bit, but we're still declining with our regular NYSE advanced decline line. This other regular NYSE advanced decline line, they're the same thing, but they're calculated in a slightly different way. That's why I show both of them. This continues to show that we're declining. And when we look at the NYSE common stock based on the advanced decline line, we are declining here, where we actually ticked up we ticked up a little bit based on price and just barely based on volume. We're still below zero with the new highs, new lows on the NYSE, and we're declining with the cumulative S&P 500 price as well as volume, even though it ticked up just a little bit there. We're also looking a little more negative with the new highs, new lows for the S&P. We're dropping below zero. So that's causing our 50 period to go down. However, we're still above zero longer term with this indicator. We're also dropping below 50 based on this indicator, another measure of the same kind of thing. And we're showing just a little bit of a turn up here with the NYSE common stock with our advanced decline line studies. We're flattening out with the S&P, flattening out with the mid caps, and actually bounced up a little bit with the small caps. So we're still coming down here with the daily chart, and we're wondering, will we find some support at this pivot point according to this chart? Well below the 50-day moving average, and we're below average with volume. We're continuing to decline with our 20-period moving average study here as things are turning more negative in the short term. We're still extreme negative with the Stochk RSI, the Williams percent R, the CCI 14, and the CCI 20, our short-term indicators, which it doesn't take much for these to get extreme negative, but they can stay that way for a while too. Here's the rate of change going back 5 periods, just barely starting to get to an extreme negative reading. Maybe we finally are able to find some kind of support at some point based on this chart. We're turning up just a little bit with the 20-period exponential moving average. Even though we've been going down, this is starting to turn back up. That's one of those strange things. The 50 period's also turning back up a little bit, as is the 200, but they are still more negative. We're dropping below zero and looking more negative with the boom indicator as we're getting we're getting extreme negative based on 20 periods. We're dropping below the midpoint with the 50-period moving average study, and we're declining with the 200-period moving average study. And for the third day now, we're still down at the Keltner band, the lower Keltner band with the force index. We're extreme negative with the short-term stochastic, intermediate, short-term stochastic, and just barely starting to get extreme with the long short-term stochastic. And this is just a further subdivision of the short-term time frame. We're just barely getting into the -3 standard deviations channel, meaning that we've gone down a little far, a little fast. And you might hear a cat in the background. He wants to say hello to everybody. So we looked at a 5-period rate of change, which is starting to get extreme negative. Now we're looking at more of an short to intermediate term based on 20 periods. This is also starting to give us an extreme negative reading. The CMB composite, this is supposed to be a standalone trading system. I use it like an oscillator, and we're dropping below this black line. But as I like to point out here, I put this black line on here, so there's nothing magical about it. I just kind of eyeball it and go, okay, when we get to this point, we're extreme positive. When we get to this point, we're extreme negative. So this is just more of a warning sign at this point. Balance of power continues to be negative. The go, no-go system is saying stay. Right now, we have the deep purple, smoke on the water look going here. And we're declining with the lowest low value, and the midpoint is continuing to decline. The TTM squeeze is extreme negative. Now, if we keep hauling to the downside, we might come to this other black line here, which again is another line that I put on here, but it's more just for reference. We're continuing to decline with the 50-period double and triple exponential moving average steady, and the red line is dropping below the blue line, meaning that we're picking up a little bit of steam with the downward move. Keeping an eye on the 50-period moving averages, we're below them. If we do see some kind of a bounce, are one of these moving averages going to provide overhead resistance? And we're keeping an eye on the 100-period moving averages. We're still above them, but if we continue to fall, will we go down and actually try to test those? The Bollinger Bands are no longer extreme. We spent 3 days with the percent B being extreme negative. We're finally coming out of that now. The ease of movement continues to decline, and you could make a case that we're starting to get extreme negative with this indicator. The Arun continues to be more negative. We're below zero and declining as the red line is pegged near the top and the green line is coming down. The red line are sellers, the green line are buyers. And we're bouncing up just a little bit here with the S&P McClellan oscillator after giving us an extreme negative reading. And with price going down and this starting to bounce up, is this foretelling us something? We don't know at this point. But since we're below zero with the McClellan oscillator, we continue to decline based on price, and we're below zero and declining based on volume. We're also bouncing up a little bit with the NYSE McClellan oscillator after giving an extreme negative reading, but we're still declining with the summation index based on price and volume for the NYSE. We're getting extreme with the Swenlin trading oscillator based on price. We're starting to flatten out just a little bit based on volume. But our momentum is clearly negative. The PMO is going down. When we break it out based on price and volume, those are also negative. And we're starting to turn up a little bit with the PMOs that are rising after being extreme negative. We're still declining with the buy signals. We're also declining with the PMOs above zero. The Elder's impulse system for the S&P continues to be negative with a red bar. The parabolic SAR is negative. The slope oscillator is negative, but we dropped below this red line. Again, another line that I put on here. This is just to let us know that maybe we're going down a little too far, too fast. The MACD is dropping below the midpoint here. This green histogram, that's the zero area. And for the first time in 2024, actually the first time since, well, last November, we're finally seeing the MACD turn more negative. So in the short, intermediate, and long term, all of our oscillators are going down and turning more negative, with a few of our short term, especially the slope, starting to look extreme negative. We're still below the 50-period moving averages in our moving average tree, and we're dropping below 50 with the bullish percent index. This is turning more negative. It's already negative when we drop below 70 and kept declining. Now it's turning even more negative since we're dropping below 50. We're still above 50, but declining with the NYSE bullish percent index, and we're getting extreme negative with the NASDAQ 100 bullish percent index. Now, this could still go down more than where it's at right now, but this is the lowest reading that we've seen on this chart. We're declining with the money flow index. We're declining with the ultimate oscillator. We're negative with the vortex. And we're starting to get extreme with the RSI based on 9 periods. We're continuing to decline below 50 with the RSI based on 14 periods. We're looking more negative with the on-balance volume. We're below the moving average, and the moving average is rolling over. We're starting to turn up a little bit with the stocks inside the S&P above their 20-day moving average. We dropped down below 10%. My goodness, that means 90% of the stocks were below their 20-day moving averages, and starting to see a little bit of a turn up here, but we are negative, yet extreme negative. We're turning up just a little bit with the 50-period moving average steady, but we're below the 50 level. That's negative. And we're declining here with the 100-period moving average steady, and we're flattening out here with the 200-period moving average steady. The Copic curve is negative. The Sean trend meter is flattening out, but still the context is negative. We're coming a little bit deeper into the Ichimoku cloud, wondering if some area in here will provide support. We're keeping an eye on these longer-term fib levels now after hitting the all-time high if we really start to go down. And the standard deviation going back 10 periods shows that we have been moving down with some real velocity lately. We're negative with the Heiken Ashi, we're negative with the Kigi, negative with the Renko, and negative with the 3-line break. Long term, we're below this very long-term pivot point here that we were watching for a long time. And unless we have a really rip-roaring day, we're probably going to close the week out below this line. So that's going to turn things a little more negative longer term. We're still just a little bit extreme positive with our 150. We're just coming off of that with our 200-day moving average study. And we're negative in the short term. According to the Keller market model, I'm more negative in the intermediate term where these signals are still positive. We're still negative with bonds based on price. We're negative in the short term, and we recently turned positive with commodities in the long term. No changes here on the decision point scorecard. Started off with some negative things happening. Then we had a couple of positive things where the S&P had the BPI cross below 50, which I just showed you that chart a few moments ago. And equal weight, that's the red line. It is really starting to underperform the S&P 500. And we declined a little bit with our ratio. That just means that the equal weight underperformed the bigger stocks. The Dow is pretty much chopping more or less sideways, but below this S2 pivot level. And we continue to be neutral with the Elder's Impulse system when looking at the diamonds. We're coming right down to this S2 support level here. So this support for right now is holding. But when we look at the NASDAQ 100, we are just a little bit below this S2 level. So this support is not holding, at least for right now. We're still negative with the QQQs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is negative, and we're still negative, looking more negative here with the QQQs. Small caps were actually up just a little bit. They are right just a little bit below this S2 level right now. We're wondering, are they going to come down and actually test their 200-day moving average with the S&P small cap index? And we continue to be negative with the Elder's Impulse system when looking at the small caps. Now, this is the Russell 2000 small cap index, where we continue to show more weakness after breaking below this support level. We're below the 50-day moving average, but still above the 200-day moving average, but the momentum is negative. The mid caps coming right down to this S2 level here. So this support level is holding at least for right now. But we still continue to be negative with the Elder's Impulse system for the mid caps. Apple was down after coming up to its 50-day moving average. It's been coming back down. And I think they're reporting earnings here pretty soon. We'll have to see. I don't follow it that close to know if that's what's happening. Tesla is under a lot of pressure, down over 3.5% and in a downtrend. NVIDIA is also dealing with its 50-day moving average. Is it going to bounce up off of that or end up breaking down below it? Also keeping an eye on Microsoft. It's now starting to drop below its 50-day moving average, and this has been one of the stronger stocks of the Magnificent Seven. And we're keeping an eye on Meta. So far, it's a little bit above its 50-day moving average. Is that going to hold? Will we get some kind of a bounce from that? Amazon, haven't shown this chart yet, coming down to its 50-day moving average. And then the FANG index is still below its 50-day moving average. The financial sector is still in an uptrend, but below its 50-day moving average. The dollar continues to show more strength. And here's another look at how we've been breaking out above that downward sloping trend line. Oil has been falling back, but we'll have to see if that's going to change with this new escalation in the Middle East. And when we look at the S&P and compare it with world stocks, the short-term relationship is getting a little stronger. We're still pretty much flat with the longer-term correlation. And we're below the 50-day moving average with the total US stock ETF. We're dropping below this weekly trend line now. We're going to have a good day on Friday to get that back. Now, it's not necessarily the end of the world. This is a weekly chart going back to 2009, but it just will turn things more negative if we end up closing below this trend line. But we're still hanging in there. When we compare the Qs to the small caps, we're right up about at this previous high reading that we saw. We were up with the 10-year yield. We were down with the 10-year based on price. We're not really seeing any improvement here. In fact, we're seeing weakness when we look at the Qs to S&P, discretionary to S&P, and large cap growth versus large cap value. So we're seeing weakness with the large caps, mid caps, and small caps. We're also coming right down to this 50 level. If we drop below 50 with the 10-day average of the S&P 500 highs minus the lows, that's going to shift things more negative. And we're also coming down with our 19-day exponential moving average of the advanced decline ratio. If we drop below this red line, that could give us an extreme negative reading. We're continuing to decline here, even though we bounced up slightly based on volume. And we're below zero with our broad market measure of the 5-period moving average of the highs minus the lows. So what's our outlook for Friday? It will be options expiration, which can be a crazy day anyway. I know there's daily and weekly options, but most folks, including myself, tend to focus more on the weekly expiration when we're setting up different option positions, and these are going to expire on Friday. That can bring in a lot of volume. It can bring in a lot of movement into the market. Now that we're dealing with that 5,000 level with the S&P, are those options going to be in the money or out of the money by the time we close? Our technicals are negative in the short and intermediate term, and we continue to be below support, meaning that 50-period moving average, not only for the S&P, but across a lot of different indexes and even individual stocks that we're seeing. We're not going to have any economic reports. And the big geopolitical event right now is what's going on between Israel and Iran. So no economic reports on Friday, nothing really to show here. Seasonally, we're positive with the Dow and the NASDAQ, but we're neutral to negative with the S&P. So not really getting much here. And this will be the last day before we have options expiration, and then we'll go into next week, which tends to be positive as well. We'll be on the 15th trading day of the month, where we see a little bit of positive seasonality with the green dashed line. This is an updated chart that Jeffrey Hirsch posted on Twitter, where the red line, this is what we're doing right now, as the S&P has been coming down in 2024. And then he changed this over to green, which we might see some weakness that takes us into the latter part of May. But we might see some bounce in here as well, because we not only were outperforming to the upside, now we're starting to outperform to the downside with this previous measure. Friday is one of the more positive days of the week compared to what happened in 2023, and we tend to see more strength going into the latter part of April. And now we're starting to hit the negative time, according to Tom Bowley's research. This will be the 19th, so we have a few days to deal with there before we might get back into more positive seasonality. The warning signs, our equity put call ratio based on 5 periods is going up. Parabolic is negative. The bullish percent index is below 50 and declining. And the bullish percent index for the NASDAQ 100 is extreme negative. The chicken money flow is extreme negative. The chicken oscillator is negative. The ultimate oscillator, Koppel curve, and vortex, those are all negative. I took out the negative divergences for right now because since we're going down, the market's kind of playing into those things. But our oscillators are also declining after they had been extreme positive for most of 2024. And we're below short, intermediate, and long-term support for the S&P, and the momentum for the NASDAQ 100 is negative. Positive signs, again, a very short list here. The long-term trend is still positive. The financial sector is still positive, but even it's dropping below its 50-day moving average. So our conclusion, we're negative in the short and intermediate term, and we continue to be below support, which is pretty critical. And now if we close with unless we have a really solid Friday, it looks like on the weekly charts, we're going to lose that support as well. In the short term, we are negative but oversold. We're becoming more oversold in the intermediate term. We're below support and negative, where we're still positive in the long term. And I put the overbought or OB over here because of the 150 period moving average study. Thank you. I really hope you found this helpful. We'll keep a close eye on what's developing, or maybe it's already done by now. But I hope you have a really good day, and I will talk to you in the next video.